In this interview with Chris Graebe, a seasoned early stage investor with a focus on AI and tech, he shares his insights on navigating the challenges of early investing and, of course, trends shaping the future. Stick around as we'll get him to share a few of the companies he has his eye on. Let's get started. Welcome back, everyone. Joining me today is special guest Chris Graebe with Weiss Ratings. Chris is a leading early stage investor and educator in the private deal funding space. Chris, I'm so excited to have you here today to share your insights with us. Thank you so much for being here.
I'm really excited to be here. We're going to have a lot of fun.
Yes. All right. Well, today I want to talk about something that you've been covering that's caught my attention, and that is early stage investing. Now, this is kind of something that might scare some investors away. I mean, we all want to get in on a stock before it hits big, right? I mean, but sometimes it does cause a little bit of uneasiness if there isn't maybe a track record to follow. So let's kind of dive in here. Chris, can you share maybe your philosophy here on early stage investing? Especially, I know you kind of lean towards the evolving tech and AI sectors. So how do you try to identify these potential unicorn startups in these domains?
Yeah, I like how you say try. I mean, obviously, no one has a crystal ball, but we're out there trying to find the best startups at the best stage at the best valuation. Now, that can seem like it's almost impossible, but let me just go back a little bit. People
Yeah.
might not know that in 2016 there was some legislation that went into place called the Jobs Act. It was signed in 2012 by President Barack Obama, went into law in 2016, that made it possible for anyone, everyday investors, that had the chance for the first time since the Great Depression to invest in early stage startups for sometimes as little as $100, which is great. Now that was the very, very early days, and here we are. It's not that far off from
Mhm.
2016. We're just 8 years since that time, but this space has even matured at a rapid pace since then. The Trump administration came in and made the law go from where a startup could only raise 1.2 million to now they can raise up to $5 million from retail investors. So that means everyday investors can get in startups at some of the earliest stages. Now, going back to what you said, that does bring a lot of risk with it as well, because a lot of times there's startups who are just like, hey, I can't get money from venture capital or private equity firms, so I'll come over here and raise from the crowd. Or maybe a company's got a big name for themselves, but they're struggling on cash. They're like, well, let's go see if we can get the crowd. So they're gonna come in at a much higher valuation. So for me, what I'm trying to do, I stepped into this space back in 2019. I was an entrepreneur myself and love the world of startups. And we all hear the big stories of people who hit it big as an early investor in Airbnb and
Mhm.
Dropbox and Facebook and all these massive, crazy returns that they had. Well, I'm trying, and where I'm at is to find the best deals for myself and ultimately those who invest alongside of me. And so I'm looking at all sectors. I want to try and find the best deals, the best startups with the best valuations that ultimately have the opportunity to either IPO down the line or see some kind of acquisition M&A situation where I will see a big return on my money in a check. And so for me, I'm placing bets across the spectrum, similar to what a VC or private equity firm would do, in hopes that some would return my money, knowing some will fail, but ultimately hoping that some will be the big payday on the backside. And I love all sectors, but obviously right now I've got a lot of my attention on the world of artificial intelligence.
Secure your financial future with MarketBeat's exclusive report, 7 Stocks to Buy and Hold Forever. Dive into the insights of proven winners for income investors as our list reveals why these 7 stocks boast very promising long-term outlooks. Don't miss out on the opportunity to grow your wealth with confidence. Download this free report today and start building a portfolio that stands the test of time. So, given your experience with all this, Chris, what emerging trends do you think that are most promising for early investors to focus on right now?
Well, the thing that I think is really interesting right now, I mean, I think if anybody wants a word for this last year, even right now, it's disruption. I mean, like there is massive disruption everywhere around us, and if you don't see disruption happening, then you're just not looking. And disruption isn't just in this one sector or this sector. I mean, obviously, artificial intelligence is going to disrupt everything, and it already is at
Mhm.
a massive scale and getting faster every single day. One of the spaces that I think is going to be disrupted, and I think we're already seeing, is the world of venture capital and private equity. Before, if you were a founder and you wanted to start your business, you had a very clear plan. You would You would go build your business, you would bank with Silicon Valley Bank, whoops, and then you would go get your money from private equity, right? You would do that, and then you would have this playbook, and then you would exit at a big multiple down the line. Well, now there's so many options. Cash is sitting on the sideline when it comes to VCs. And I think the traditional VC and private equity model is being upended in a big way. And, they're just throwing darts at a board anyway, hoping that they hit big, or they're just, they're in Silicon Valley and they're hoping that they'll just get in on a deal that this other famous person's in, or this big other firm's in, or whatever. There wasn't, they have analysts and they're looking, they're doing the research. For them, it's just a numbers game. But I think there's a world coming, and it's already here, where the everyday investor is going to absolutely have the power in their hands, to where founders are like, I don't want to give up a board seat and complete and total control to some VC firm that really doesn't care about me, just sees me as another number, and hopes they're going to push me to make poor decisions for growth so that they can see a multiple return on their money. Where they're going to go, okay, well, let's go to the crowd. Let's go to everyday investors who are going to be brand ambassadors, who are going to cheer us on, who don't need a board seat and maybe don't even have voting rights, but they have equity in the company and are willing to cheer them on along the way. I think founders are going to start to realize that this is a smart bet, and not, I wouldn't say a safe bet, but a really interesting bet for them to go to the crowd and have 1,000 people come invest in them, versus one big wig player that they have to take the check from them and have to give up a large percentage of their company and have to give up a board seat. I think there's massive disruption happening right there in that world. Obviously, there's disruption across the landscape, but I think that is a place that is going to rapidly be changing here in the next few years. And the other thing to say is, if you're a startup and you want to raise $5 million, you have to go get an audit, but you can raise $5 million from the crowd every 12 months, which is pretty interesting. And not only that, but the SEC, from what I understand, is considering raising that number even to a higher limit. So where the pre-seed and the seed rounds were typically, they're the most risky rounds, but once you've gained some traction, there's a big chasm to try and get to that A round where you want to raise 15, $20 million. And I think this bridges that gap for startups and gives the everyday investor an opportunity to jump in as well.
Chris, I just want to say I'm loving this interview already. You're bringing some great insights to the table here. I'm excited to keep talking. But you had mentioned a little bit about how you try to identify these unicorns. But can you maybe tell us a little bit more in depth about the criteria that you're using to maybe evaluate these early state startups? Are there specific indicators or metrics that suggest maybe a higher likelihood of success with these?
Yeah, I think, people ask all the time, like, where are you? Because there's
Mhm.
all these different, there's pre-seed, there's seed, there's post-seed, there's all these different little rounds in there. Really, what I'm looking for is, I'm looking for a company that isn't just in ideation. Like, I've got an idea and check out this
Right.
napkin or whatever. I'm like, that's way too risky for me. I'm like, maybe
Mhm.
you have the greatest idea in the world. Go execute and show me that you're solving a problem that the world's willing to pay you some money for. So typically for me, I always want to find a company that's at least in revenue, or they're sitting on some sort of intellectual property and they're moving the ball down the court and they've gained some significant traction. One of the other things I kind of share with the members inside of my membership group is I talk about just really kind of four main things, like the acronym FIVE, FIVE. So the founder, F stands for founder. The founder of the founding team is everything, because a startup inevitably is going to need to move and pivot and make changes along the way. And it all comes down to the resiliency and the ability of that founder to see what's happening in the market and be able to pivot along the way. So if the founding team, if you're a little nervous about them, or you don't think they have what it takes, that's something I'm definitely a red flag, and I'm walking away from that.
For sure.
I stands for industry. So I want to look up and say, like, okay, what industry or sector they in, and what is the timing of that particular industry? If someone came to me today and was like, hey, I got this great idea for a cannabis startup, I was like, well, that was like 7, 8, 9, 10 years ago. You kind of missed that train now.
Mhm.
And then you have to look up and go, okay, are they late? Are they too late to the party? Are they too early to the party? Like, oh, we believe that flying cars are just around the corner. Like, well, no, they're not. Like,
Mhm.
it's going to be a while for that. So finding an industry that's growing, that's has opportunity, that has potential and has upside, and hasn't missed it, or isn't too early, is something I'm definitely looking at. So that's the I. The next one is the V for valuation. I think it's just like real estate. Anytime you invest in a startup, anytime you make money on a real estate deal, you make money on the purchase. Same thing is going to be true when it comes to investing in a startup. If you get a good valuation on the front end, you have the opportunity to see the upside down the line. Even if they have a down round along the way, you've invested at the best possible valuation of the front end. So valuation is always good to me. Sometimes I'll have founders show up and they're like, I am worth $100 million. I was like, what in the world makes you think you're valued at $100 million? And so valuation is key. Investing at the right valuation is key. And then ultimately the E is for exit potential. Do they have a path to liquidity for me as an investor and anybody else who's going to invest in this? And so doesn't mean that it all has to shake out exactly that way. But if they're like, no, we're just going to take your money and then live on for the rest of our life and maybe never think about it. So if there's no exit potential and I can't see potential buyers or someone who would acquire them, or see the fact that the IPO market would be the way for them to go so that there's a return on capital, then for me, that's typically something that I avoid and don't go. So you're looking at founders, really important. Industry and timing is very important. The valuation and ultimately the exit potential of that startup. Those are some just high level things. We do a lot of due diligence, have our analysts ask a lot of questions, but someone who's starting out and it's like, okay, how do I go? I go to some portal and I'm looking at some of these startups. Where do I start? Those are some things that they can start looking at right now today.
Yeah, that is a great acronym that makes it a little bit easier for investors. So one of the things that I think people kind of might push back on with this type of investing is, of course, the higher risk with it. You briefly mentioned this again, but what are the most significant challenges that you face when you're investing in early stage AI and tech startups specifically? How do you kind of balance that out? Are there maybe some common pitfalls that you can help us steer away from, Chris?
Yeah, sure. I think when it comes to anyone's portfolio, I think you should, especially when it comes to startup investing or anything, it's like, okay, this one is a little bit more of a riskier play. Like if it's like maybe there's a startup that's in a particular niche and sector and they are in an arms race. You know, there was a company we invested in many years ago that was in the like virtual Zoom online meeting notes. And you're like, okay, cool. Like this was 2020. Everyone was going to Zoom, everyone was going online. But we knew, okay, if they have great technology, their team wasn't as strong, but it
Mhm.
was like this is an arms race, and so we had to go like we know that this is a little bit of a riskier one. Okay, so it was like have to know that in your portfolio, and I always encourage people, and I do the same thing myself, is you spread your investments around. It's you want to make sure, like I said earlier, just like the big venture capital firms do, like they're going to put some in this one, they're going to put some in this one, they're going to put some in this one. Now, there's a startup that I invested in last year that was actually it was 2 years ago. They're a candy company. They're a nationwide candy company. Has been around for 20 years. They're doing $30 million in revenue, and they are a very solid bet. Now, they're not going to return 100x down the line, but you know that they're one of those safer bets. They decided they gave away a dividend in their first year, kind of one of the first time that's ever happened in the world of equity crowdfunding. And then they went and did $30 million in revenue, and then the next year they did $41 million in revenue. This year they'll probably do $60+ million in revenue. And when they hit that 100 million spot, maybe they get to go to the IPO or someone acquires them and they may return a 4 or 5x. And so it's a little bit more of a standard play there. So I'm always looking at diversifying inside the portfolio. What are more like a less risky play? Who's already gaining traction? I try to find startups that are already gaining some traction and have
Mhm.
already kind of made their mark. Now, look, startup investing is risky. Investing in stocks is risky. You know, it's all
Mhm.
risky. And you have to understand that going in. And so anybody who's starting off in this world of early stage startup investing, I'm like, hey, you want to dip your toe in, you want to go look around, you want to go learn, you want to understand, do some research, and then, you know, because the other thing you got to watch for is founders. So, you know, let me back up. The way this whole thing works, there are funding portals out there where I'm a founder and I want to go raise capital for my startup. I can go to this funding portal and I put a listing up there. It's called a campaign. And you can go search these different websites like Republic and WeFunder and Start Engine, and there's a bunch of them out there. And you go look and you're scrolling through all these different startups. And so what's happening is these companies are putting their absolute best foot forward. They're the ones helping create their campaign page. So they're going to tell the best story possible. Now, there's certain things they have to put in there per SEC rules which helps the investor understand where the risk may lie, but they're trying to put their best foot forward. And some of these founders are marketers, and they're great storytellers, and good for them. They believe in their brand more than anyone else on the planet. They should, as a founder. But the thing is, that early stage investor, what you have to do is, if you don't understand the sector, you don't understand the market that these particular founders are in, I would challenge you to go do some research, because you can get wooed and wowed by a founder or someone who's doing something that's new and trendy right now, but they may not have any merit behind them. They may have no technology behind them. They may not have any money behind them. They're just putting up a great campaign page that tells a great story, but you want to be really careful of that. So, don't be wowed and wooed by a story and a founder. Look at the numbers, look at the track record. What have they done with someone's money who's already been invested in their startup? If they've been diligent with that, they will be diligent with yours. Great example. There's a startup I invested in, which is an AI company. This was last October, and they're in the tax space. They're looking to disrupt tax when it comes to the world of enterprise tax. Well, they had went and raised $5 million. Well, for them, they didn't need the entire full $5 million, so they took a large chunk of that money and put it into a 5% returning money market to say, hey, look, investors gave us this money. We're going to be good stewards of this money. We're going to go make 5% on this money until we need it. And then, so as an investor, that's a really good move for me. But if it's a founder who's like, what, well, we needed all of that, and now we're in the hole again, and we need to go raise more money. Well, that just tells me that they're not diligent and disciplined with the capital they have. And so those are some of the things that I'm looking for. I'm making sure it's not just a marketing ploy, it's an actual real company. I'm seeing what they've done with the money they've already brought into their world. And then when it comes to portfolio allocation, I'm making sure that I'm hedging along the way with some that are a little bit safer plays, less of a bigger return on the backside, maybe single base hit, double here or there, and then hoping for the home runs along the way as well, knowing ultimately that some of them will fail and won't make it down the line.
All right. Now, knowing the trends that you're looking at and kind of the criteria that you use to hopefully find these up and coming companies, Chris, are you willing to share some of the specific companies you've been taking a look at recently?
Yeah, for sure. I will talk about I can talk about some of the companies that I've invested in, some that people might know. And
Yeah.
like I just mentioned, one is Cipher Tax. It's a AI software tax, completely on the path of disrupting the world of enterprise tax. And the big four, I believe one of them is probably going to end up buying these guys along the way. There's a company I invested in not too long ago. It was in the world of, it had artificial intelligence and it had oil and gas in the mix. And so anytime AI by itself is really neat, but anytime you can see AI, so these are two examples, right? AI and taxes, AI and oil and gas. And so I think AI is amazing. Obviously, there's a lot of people out there going, yeah, we have AI, and they'll just throw the name AI
Right.
on it. It's like they're just tapping it into like Chat GPT or something.
Mm-hmm.
So 2020 was a company I invested in, a couple I invested. One's called Beatbox Beverage. They're an alcohol-based brand. They were featured on Shark Tank. I had the opportunity to invest in them at a $60 million valuation. This last year, they just did, in 2023, they did $100 million in revenue. They're on track to do somewhere around $280+ million this year alone. They are basically tracking along the lines of what Celsius did. And Celsius is now $1 billion company. So my hope is by 2028, that company will be around $1 billion in annual revenue, which should put them somewhere around a 5 to 7 or more billion-dollar valuation, which would be a really nice payday for everybody who invested alongside me there. I invested in another artificial intelligence company back in 2020 called This Way Global. The founder is Angela Hood, and she is working to eliminate bias from the hiring process, which you can imagine a startup like
Right.
that. And it was artificial intelligence before artificial intelligence was what it is today. This is 2020. She basically had bias leveled against her when she was trying to find an architecture job out of college, and decided this was a problem. Well, since investing in her, she has partnered with Google, and she was Google accelerated, and she's partnered with IBM, and they are absolutely crushing it, seeing
Awesome.
really, really big numbers. So there's just a couple companies that I've looked at, that I've invested in, and we've got our eye right now on some other artificial intelligence in the world of med tech. And we're also even looking at some in the world of some traditional I guess when it comes to traditional acquisitions where there's legacy brands that are looking to move on but have a lot of potential for growth inside of them, and where PE firms and hedge funds are looking to acquire them, scale them up, and then exit out in a short period of time. So we're looking at all different sorts of sectors and startups. For me, I don't get hung up on one in particular sector. I'm looking for sectors that have the potential to make good money and bring good returns for me and for those who are investing alongside of me. And ultimately, it comes down to the leadership inside of the organization. Look, if you're not humble, look, I'm all about having a little bit of an edge to you, a little bit of kind of confidence to you. But if you're not humble, you're going to get smacked in the face, and then you're going to get smacked in the face with my money in your hand. And I don't want that to happen. So humility is another huge factor I look for when it comes to investing in a startup or a founding team.
Well, Chris, thank you so much for sharing your knowledge and vision with our viewers today. Tell us, where can people find you for more?
Yeah, I'm at Weiss Ratings, lead a service called Deal Hunters Alliance, where every single week I'm giving the ins and outs of what's happening inside of the world of private equity, specifically in the world of equity crowdfunding. And I love educating and helping everyday investors realize that this is something that can become a part of their portfolio. Look, we're 8 years into this space. It's still really new, but it is growing significantly and very, very quickly. And I'm excited to help every single investor here in America understand that they can make this a part of their world and portfolio. So you can find us at Weiss Ratings, and I lead Deal Hunters Alliance.
Awesome. Well, I will go ahead and get all of Chris's information linked down below. So go ahead and check that out. As always, MarketBeat is here to help you with your investment research. So don't forget to check right back here for more. Thanks again for joining me, Chris. I hope we can talk again soon.